following is a presentation of TFNN. The Trader's Edge with Steve Rhodes. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. The Trader's Edge. Now, Steve Rhodes.
Good afternoon from TFNN. Welcome to the December 3rd. Today, the 3rd? Yeah, December 3rd. Terrific Thursday edition of the Trader's Edge Show. I'm your host, Stevie Perseverance Rhodes, who absolutely knows that each of us should always be pioneers of our future versus prisoners of our past. Hope everyone out there is having a great day. Let's make sure we have an extraordinary Thursday. Of course, the easiest way to do that is to always remember that life happens for us, not to us. That's right. When you and I make that one little 2x4 shift, it means we can find the gift in every set of circumstance that life is going to toss at us. Today, we're going to go look at the circumstances of the bulls and the bears, the buyers and the sellers. We'll go figure out what they're communicating to you and I as of about just past 1 o'clock in the afternoon on this terrific Thursday. Of course, I'm absolutely grateful for your presence here. Now, I'm here to serve you. So feel free, pick up that phone, dial on in, 877-927-6648. Internationally, 727-445-1044. Of course, you can send me an email, steve@tfnn.com. Ping me inside the Tiger's Den. I'll do what I can to get to your requests out there on this terrific Thursday. Of course, this is Tiger Financial News Network. I'm Steve Rhodes. Welcome to the show. Right now, we got the Dow trading up 135 points. She's trading at 17,594. The S&P is down about 20 points, trading at 2060. NASDAQ Composite off 63 points, trading at 5,058. Russell 2000 down 9 points, trading at 1182. The DAX finished off 400 points. The FTSE down 145. Gold is up about $6 right now, trading at about 1060. Silver's up 4 pennies at 1405. Light sweet crude up $1.58, trading at 41.52. Natural gas up a penny. Lead the charge to the, and what we're going to first begin talking about here is going to be the currencies, right? We've got We've got Mario Draghi now out of the way. We've got Janet Yellen out of the way. And we're certainly going to take a look at currencies, a perfect reason why you need to have stops in place, because it just simply wiped out anybody who didn't, or many people that did. So the move in the currency market, huge displacement out there. And, the dust, I don't know if the dust has settled just yet, but we'll go take a look at that. In the meantime, though, leading the charge to the upside, we've got Avigo Technologies up about 10%. That's $13. Priceline up $6, 0.5%. Sanderson Farms, first time I've seen a commercial from Sanderson Farms, and they're up about 7.5%. Saw that last night, some type of course, chicken commercial out there. We've got Costco, that's up 2%, $3 out there. To the downside, Chipotle, that's off $13, a little over 2%. Regeneron Pharmaceuticals down $10, about 2%. Google's off $11, a little over 1% out there. So let's begin by taking a look at now. I not to switch back and forth or anything like that, but let's take a look. Let me before I go to the currencies, let's do this. First, let's take a look at what we do have as we speak right now at 1:10 p.m. is we've got sell signals all over the place. Now it's going to be dependent upon how the market closes. So as of 1:10 p.m. If we go take a look at our oscillator readings, our advanced decline oscillator readings inside the New York Stock Exchange, well, they're clearly below zero. Prices moving right down to, it's testing the support of its 50-day exponential or smooth moving average. 10,312 is the number. You're trading at 10,000, basically 312 as we speak right now. Not oversold or anything like that in one day, so it's got room to move lower, but that's in possession of the bears' hands. If we take a look at the NASDAQ Composite, if you're watching this on TigerTV, so left panel of my screen is New York Stock Exchange. One next to that in the right is the composite. That's what we're talking about right now. And inside the composite, its price oscillator reading is now below zero, just slightly below zero out here. And as far as where is price likely to go to, we'll take a look at that. One target could certainly be the 200-day smooth moving average. That's at 49.74, maybe some type of retracement. The Dow trading right now on its 200-day line. Its price oscillator is moving pretty quickly down towards an extreme oversold reading out here. Not that it can't go lower, but that's what it's been able to do. In the last 2 days, yesterday and as well today. We take a look at the VIX index on the bottom, very bottom right. In fact, let's just do this. We'll blow it up on my screen out here. The VIX index is the better way to really keep track of what's going on inside the S&P 500. As we can see, right now it's trading at 1756. Now, the 50-day exponential moving average is 1713. Whenever the VIX trades above that level, that's when you can see some major demolition, price erosion inside of the market. So the key number to be watching today is going to be, as we speak right now, 1730. That may fluctuate as price moves up and down, but right around 1713 is the number. If we take a look at the actual movement today, so far it's a little over 10%. So if the VIX closes here at 10%, you have to anticipate that the market will have some type of bounce to bottom in store for it. Either in at least the overnight futures or morning futures contracts out there. That's typically, and when I mean typically, I'm telling you 90% of the time, that's what you see. If we get less than 10% of a one-day rate of change inside the VIX, then all bets are off. But it's a combination, and paying attention to the VIX is very important, because if it rejects the 50-day, closes below, we'll say 1713 right now. Then you don't have any confirming message inside the S&P 500. Now the ES Mini, I gave you numbers yesterday. Price is trading below those numbers, so that says, hey, it's in the hands of the sellers out there. Okay, so that's the general market. Let's just simply take a look at some daily tools that you and I use out here. If we take a look at now let's go to the currencies, because that's where, currency is truly something that rules the world out here. Now, you and I, we were taking a look at the euro. Let's go take a look at the euro versus the U.S. dollar. And we really had this thing pretty well pegged out here, right? Yesterday, especially, we were taking a look at right here, just using basic swing point analysis. And that says that you go down, if you're trading within a swing point, then you're likely, if you're moving down, you're likely to go test the bottom. If you close back above it, hey, all the work to the downside may be done. And what took place, we took a look at this on, so it's today's Thursday, we took a look at this on Tuesday. And Tuesday, what you and I noticed was the swing point that was in question was priced out. The high was 1.0619. And what we noticed was that on Tuesday, you had a nice little bullish engulfing key reversal type session out there, and price closed back above that, got back inside that upper range. Yesterday, at yesterday's close, so it's not as if the market didn't know what was going on. Yesterday's close was actually a hammer. So you had two bullish candles out here defending that swing point. And that's a swing point, again, that takes you back into March of 2015. Obviously, today, it did the final test of that. It got down to the low of the swing point out here from April 13th, and then it's obviously taken off topside. Big, huge, you call it short covering rally, whatever it is, a huge, wide-ranging bar. If we take a look at just simply retracement levels out here, let's go look at those. Okay, there we go. Let's take a look at from the high. The high that we're using here is August 24th down to this morning's low. What we can see is very close to a 0.382 retracement. 1.097 would give you that number out there. So you're coming into the 0.382 retracement with a wide-ranging bar. And if we wanted to even be more conservative, what we could say, and so that says that what the euro is very likely to do is head up now to the 1.1259 level, at least the 0.618. Why? Because when you're coming into one of these floors and you're doing to the wide-ranging bar, it says we're not going to stop there. We're just going to keep on motoring through. Now, from a conservative standpoint, so, write that number down if you trade the euro. And don't write it down if you don't. We could also use our swing point out here from the October 15th area, and you can see that if we do that on a conservative basis, says that you've already sliced through the 0.382 with the wide range bar, says you're headed up to 1.112. Now, it doesn't need to do it overnight, but you'd be headed up to the $11-ish type range out there. So that's inside the euro. So that says that's going to go ahead and put pressure on the U.S. dollar index out there. So again, it's not as if just using basic candlestick charting and swing point analysis, somebody knew something, the market was communicating something. Not something the market was communicating that was anticipating that that the market would respond to Mario Draghi's comments in this way. Maybe not necessarily as fast, but what do you expect from Super Mario? So that's inside that currency pair. Now here's where the message gets a little bit convoluted, because when we take a look at the euro versus the Japanese yen, and why are we looking at the euro versus Japanese yen? It's an excellent question. And the reason that you and I are taking a look at it is because of its correlation metrics to the U.S. stock market. The absolute carry trade, the absolute best currency to be taken a look at with regard to when things get off kilter here. Can't use it as timing tool. We've got to use other tools, and we looked at those yesterday. We'll look at those again today. But this tells us when there's really a dislocation. And so if we take this currency pair, just do it for those of you that are new, but just look at the top portion of my chart, the S&P 500. The bottom portion of my chart is the euro Japanese yen. And again, if you just follow my crosshairs, you can see how it makes bottoms and it makes tops, right along in concert. It does this little two-step tango. When things get out of control, sort of as they did down here, where the euro starts heading lower, but the market starts heading higher, it's a sign that the stock market didn't get the memo, but the memo is on its way, and when it does, it'll go ahead and catch up to the direction of the euro out here. And so you can see, as you're just following my crosshairs, you can see the correlation. And when we had take place here, the most recent downdraft that we had inside of the stock market, beginning right around November 3rd, at that time we had price moving higher inside the S&P 500. We had the euro moving lower. And then, of course, we got the correction. Now, what also took place is we got that little correction, which was just a 3-day deal out here, 4-day deal. The bottom that came in on November 13th, the market started moving higher, right? Started moving higher out here. It's the top panel on my screen. But the euro continued its move lower. Euro, Japanese yen continued to moving lower. So today, or what we are doing right now, or what's going on right now inside the market, we're getting that reaction. But here's the deal. If we take a look at the euro Japanese yen, let's go back now. You can see the diagonal line on my chart out here. You can see that it's really right up against a trend line. Now, this is the closing price that we're looking at. So it's really right up against resistance. If it continues to move higher and take that out, then it says that what you and I are seeing in the market is some type of retracement. And it's really up to you and I to go figure out, where's that retracement going to go ahead and take us to? Not like it's an ultimate top or something like that out there. That's the message of, and that's the reason why you and I want to pay attention to this currency pair. But let's go back and take a look at the currency pair alone. And as we do that, you're going to see also a wide-ranging bar out here inside the euro Japanese yen. We know that from the most recent low, which was out here on April 14th, to the high of June 9th, price came back, and we took a look at this yesterday, where it basically made about a 0.786 retracement in one of our floors, our Fibonacci floors out there. So we get back from this break. Let's continue taking a look at the euro Japanese yen, and over the next few days, more than the next few days, we'll want to keep track of what's going on inside this currency pair. Steve Rhodes with TFNN. We'll be right back. Hi, I'm Steve Rhodes, host of The Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Steve takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Welcome back, folks. Dow's off 113 right now. I had a question come in and ask me, is the market going to bounce? And the answer to that is yes. We'll go back to the euro Japanese yen just in a moment. But if we take a look at one of your favorite tools in mind, that's when price starts to move higher or lower, does it with less relative energy out there. You know, it gives us a signal. Now, that signal is the way that the market communicates to us in providing us with its language of bullish and bearish reversal candles out here. We can see on the 10-minute basis that earlier this morning at about 5:30, off of the low out here from 4 o'clock yesterday afternoon, that we got to that nice little seventh wave move out here, and price continued to move lower, obviously from that time frame. Now, as it was moving lower, right here at 1:10 p.m., at 1:10, so just 20 minutes ago, not even 20 minutes ago, 15 minutes ago, at 1:10 p.m., we had a nice little hammer candle that formed. Prices moving lower, doing a less relative weakness out here, gives you and I a bullish signal out here. Then a bullish engulfing candle that formed here at as we went into that break at 1:20. Where price is going to bounce to is right around the 2067, 2068 mark. What you've got out there on a 10-minute basis, you've got the point of control using our TAS market profiles, and you've got a moving average line that has acted as a resistance on this move down here this morning. That line being a looks like a 21 period. Yeah, it looks like a 21 period moving average. Now, if price gets above 2,067, anticipate the next move would be up to about the 2,073 level. So you ought to be anticipating at least a bounce. That's what the market, these patterns, they work all the time. Well, I should say they fail as well, but they work a predominant. They help you and I to really gauge what the market is doing out there. It's really not that complicated when we use a set of tools that works for us the majority of the time. There we go. Now, I posed a question inside the Tigers Den, then we'll come back to the Euro, Japanese yen, because it's important for us to pay attention to. But I posed the question, any of you that listened to any of Janet Yellen's stuff over the past couple of days, the words that stuck out to me more than anything else were the term full employment. Full employment. Of course, if you go to the Federal Reserve website and you try to see what the definition of full employment is, you'll get a lot of BS out there. But you'll get it. Basically, it won't give you a conclusive definition of what full employment means. That sounds a whole lot like the Fed out there. But nonetheless, there are ways for us to take a look at employment with regard to certain metrics out there, and we're going to take a look. So my question that I posed was, is full employment or is low unemployment good or bad for the stock market? That's the question that I'm going to ask you. You come up with an answer, and I'm going to come back, and we're going to answer it together out there. Won't be a Stevieism, but both you and I will answer it. Now, let's go back to the Euro, Japanese yen, okay? This is the carry trade. It's more important to pay attention to this currency pair with regard to the U.S. stock market than anything else that is out there. As we take a look at the Euro Japanese yen, we pointed out that price on a closing basis was running right into a trend line out there. Here's the real trend line if we take a look at the candlesticks out here, if we take a look at the top of the wicks out here. And if we take a look at it, you can see the price is very close to moving into that level. Not really there just yet. Big wide-ranging bar. We haven't seen this kind of a wide-ranging bar. Last time we saw this was we saw a wide-ranging bar back here on July the 10th. That lasted for a day or so. No real resistance or anything there. But price eventually moved up higher into this August 21st level. Now, if price moves through this area, which I suspect that it will. Why do I suspect that it will? The reason I suspect that it will is if we just take a look at a retracement level, that's coming back here from the high of the trading session of June 9th down to the low that took place a few days ago. On November 27th, you can see where this wide-ranging bar coming right into the 0.382 retracement level, that number being 134.01. We're at 134.04 out here. So we're really right into it. Not we, but the Euro Japanese yen. So you're coming into a level with a wide-ranging bar. Says it really likely does not want to stop and let anybody off of that floor. So it's got this little resistance zone, which you and I have identified. And if it can clear that resistance zone, it says that price travels where? To the next resistance zone. That little trend line all the way back from the high of June the 9th, which will take you very close to the 0.618 retracement. 136.69. Now, that doesn't mean that that's where it stops or anything. And why you and I want to be paying attention to this is because, there's dislocations that are going on here. I can give you the reasons why the market should continue lower. Now, that's if those elements are still in place at 4 o'clock this afternoon in the cash market. We already took a look at on an intraday time frame out here that we ought to see some kind of a bounce in the market, we know the levels to be paying attention to out here. So inside the euro, this looks to me like it wants to move higher, and if it does that and the market continues moving lower, that's a divergence that you just absolutely have to be paying attention to. If the two get on track, that's when they do the best tango, the best two-step, and they really continue to tell you the real direction of the markets. So when we get back, let's go answer that question. Full unemployment, if that is good or bad for the stock market, not the economy, but the stock market. Steve Rhodes with TFNN. We'll be right back.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization memorization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's nadex.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
TFNN has just announced a brand new morning lineup that is geared specifically for traders in this volatile traders market. Every morning at 8 a.m., John Logan starts things off with his daily program, The Global Market Pulse. At 9 a.m., Larry Pesavento trades the market during the market open Monday through Friday on Trade What You See. At 10 a.m., Tom O'Brien hosts the Money Masters for the hour, and Basil Chapman hosts his Tiger Technicians Hour at 11 a.m. From 8 a.m. till noon every market day, these traders are with you as they provide up-to-the-second market information so that you can make the most educated and profitable trades possible. The new TFNN morning lineup is happening right now. Tune in to see for yourself what kind of actionable trading discussion they have each morning, Monday through Friday, starting at 8 a.m., live only on TigerTV at TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Welcome back, folks. Dow off 126, S&P down 17. So the question that I had posed to you, listeners, is low unemployment? Maybe that's one of the tools that Janet Yellen is using as full employment, right? Full employment, low unemployment seems fairly similar out there. Is low unemployment good for the stock market? Well, let's go find out. Because the easiest way is to answer it with data. Answer it with facts. You and I are just simply miners of facts out here. Now, this chart that we're looking at, this historical chart for the Dow, I'm not going to go back to 1896. We don't have employment figures going back to 1896, but we certainly have enough to take a look at and then maybe pose to ourselves and ask the question, really? You're raising rates now? Okay. So the answer to the question, it's really pretty simple. Typically, in the past, low unemployment is bad for the stock market. High unemployment is good for the stock market. High unemployment typically identifies bottoms inside the stock market. Likewise, low unemployment, employment where things stabilize where they stabilize and then start to rise. So we don't have rising unemployment data just yet. Doesn't mean we're going to have it next month or what have you. This is just a basic general question to help you understand the correlation. This is all we're doing is correlating statistics with regard to market behavior out here. And we can take a look, and now it's not to be meant to be used as a timing tool out here. A preparation tool, yeah. Because if you, I won't tell that joke. But if we take a look at the unemployment percentage, right? So the Bureau of Labor Statistics, the BLS group of the federal government that gives us that data out here, what we can see is that it reached its maximum right back here. This is the month. This is a monthly chart, by the way, we're looking at in October of 2009. That was where it was at its peak. And you can see that from that point forward, now the market just continued to motor on to where we're at right now, not too far away from the all-time highs out there, even, with today's movement inside the market. We can take a look at back here at the top in 2007, not the top, which took place in October, but at the top, or what I could say is the bottom, where unemployment had basically reached its trough, because then things started ticking upward. That actually took place in May of 2007. So it's really important for us to be paying attention to, because what we saw was that was an indication, low unemployment, actually bad for the stock market, if we take a look at these two examples. But you and I, we should absolutely not stop there. We should go back a little bit further. And so if we take a look at the next time we saw a peak, forget about the percentage, right? Let's just kind of keep things relative, and let's just take a look at, as we have data, peaks to troughs. The last time the time before that where we saw a peak was back here. This was in the month of June in 2003. Now, not at the exact bottom, which took place in September of 2002. Again, we're not using this as a timing tool. But sometimes, we just got to, we have to be paying attention to. So what you want to see for the market to go up is you want to see the unemployment rate continue to move down. If you start to see it continually, gradually moving higher, that's going to be an indication to anticipate a top inside the market. We can see that this thing is off by a bit, right? So it doesn't happen right away. It's not used as a timing tool. So we can see that back here in 2003, market ended up last time that it made its peak out there, right? A peak of unemployment, and then it started moving down. The market went ahead and moved higher out here. If you come back to the top in 2000, the actual top took place right in December 1999, January of 2000. Again, we're looking at the Dow out here. And as we take a look at it, the actual trough that took place in unemployment as far as a percentage, that actually took place in April of, I believe it was April 2000. Yeah, April of 2000, when it was down at about 3.8% out there. So the answer is, if you just simply go back and take a look at from the last 15 years worth of information, this helps us to understand the unemployment percentage, whether you don't have to believe it or not, whether the unemployment percentage is correct or not. The point is that, however they keep track of it out here. So if the Fed believes that the market is good, that the market is fine, the stock market, not talking about the economy, that the stock market is fine on its own and it will continue to move without quantitative easing out there. It is also communicating to United that it truly does believe that unemployment is going to continue to come down, which it may. I don't know whether it will or won't. The question that I posed to you was, what's best for employment? And you and I can continue to watch these statistics, right? We've got another jobs report that is out tomorrow, because it will help us to gauge where are we at inside the cycle of the market that we're in. And you and I, we can go back further. And it doesn't work 100% of the time, I will tell you that. If we go back, but it works pretty darn well, right? Take a look at the last time that there was, the time before that. Now we're talking about before 2000. The last time that we saw another peak before that was in 1992. And that is where unemployment got up to about 7.8%. And from then, unemployment percentage started to fall. What did the market do from that point forward? Went ahead and made that move up into the 2000 top out there. So you can see that the way that this works, it's pretty cool if we just simply look at facts. And I have contested that. My opinion is that the Fed doesn't have I watch some people ask questions of Janet Yellen. But, the reality is they needed somebody like me, I think, on staff for them, or me actually asking the question so that we could say, are you kidding me? Because the chances, right? The chances that the unemployment rate is going to just simply continue to fall and continue to fall out here, in any event, look, it's the data. So make of it what you wish out there. In any event, hopefully that was interesting to you. There's another piece of data out here that we want to pay attention to when it comes to the jobs report, and that is this right here. I've shared this with you before, and that is, let me see if I can put this up on the screen for you from this slide right here. And that is with regard to the other important factor is not how many jobs were created out here, but whether or not the job openings continue to increase. The blue line that is on my chart out here, this is updated through the last jobs report, shows us that and this also correlates to the direction of the market. And as jobs continue to, as non-farm job openings continue to increase, guess what? The market does well. When they start to decrease out here, just as they did back at the top in 2007, just as they did back at the top in 2000, guess what? As they started to decrease, the market started to move lower as well. So the jobs data is actually probably a whole lot more important for the way that you and I take a look at it here versus the way that they'll start spinning things on CNBC tomorrow as an example. Hey, let's go out to California and speak with Greg. Greg, thanks for calling. Thanks for holding. How are you doing this afternoon or this morning?
I'm well. How are you, Steve?
Excellent. Thanks so much for asking. And you're interested in talking about the VIX index, so tell me what you're doing and how I can help you.
Well, I've heard you mention it before. I was probably doing something else at the same time, but did you, and I just barely caught it this time as well, but did you say that when the VIX closes over 10% on the day that's usually when you get a market bounce the next day?
Get a bounce or a bottom? Correct.
Yeah, well, either one, a bounce or a bottom the next day, the market moves back up.
Does it within 48 hours. It does it within 48 hours. It has, over the last couple of years, it's been doing it within 24 hours.
Okay.
Like
right.
80 to 90% of the time. That's the probability that you're dealing with. So it won't happen always. But, if I could give you an 80% probability, would you take that?
No, of course. Absolutely.
And what would you do with it? So it's a way to be able to, help people anticipate what the market will do. And then depending on the time frame horizon of a trader or investor, you know how to anticipate that, maybe look for other patterns or decide on how you would actually go ahead and trade that.
Right. Because in the past, when I've, just looked at the candles trading the TVIX and the VIX, not trading the VIX, but watching the VIX for the TVIX, that you watch these really strong up days and anticipate another strong day up, or maybe 2 days up, and then it turns on me. So that's really good information.
Yeah, it's helpful. Now, when you're trading those vehicles, the TVIX, no, I don't know. I don't know if that is just like trading the XIV or the UVXY. I imagine that it is. What you want to be really focused on there are the two front month futures contracts, which are going to trade differently than the way the cash VIX is calculated. Because typically, like a UVXY, and this happens from time to time, where you'll see big movements inside the cash VIX index, but when you take a look at and you won't see much movement inside. I don't know if you've ever experienced this before, Greg. You won't see much movement, let's say, inside the UVXY. It's because it's trading off of the 2 front months out there. So it's not a 100% correlation to what happens inside the VIX index. So just pay attention, in whatever it is that you might be trading. And I'm not familiar with the TVIX, but if you go take a look at it, it will tell you what the holdings are with inside it and the percentages. Then you want to just make sure that you're paying attention to the patterns inside those futures contracts.
Okay, great. I appreciate that, Steve.
Hey, no problem. Anything else that I can do for you?
We're good to go.
Okay. That was Greg in California. That was taking a look at the VIX index. And again, his question was, today, right now, as we speak, you've got the VIX up $1.61. It's up 10.12%. I'm very specific on this. It needs to, if it has a close today of 10% or greater. I don't know if that's $1.60 in a one-day rate of change out there. What you can anticipate with a 80 to 90% probability is that you're going to see some type of market bounce or bottom out there. Again, the other 10% of the time, 10 to 20% of the time, that doesn't happen. It doesn't improve the chances if you see a back-to-back or 3 days back-to-back out there. You just these are singular occurrences out there. Now, another tool that you can add to it. Let's go take a look at it. That improves your odds a bit. Let me see if I can open this up here. Give me a moment. It might take just a minute to populate, because my system is working overtime. But that's taking a look at the TRIN index out here. So let's take a look at that. Give me a moment here. Should have just popped up. Why? There we go. Okay, so this ought to pull up the TRIN index for us. Well, I got to go find it first. But in the case of the TRIN index, if you have a closing, now there's a number of different ways to use it out here. The way that I like to use the TRIN index is, here we go, is that if you see a, whoops, moment here. If you see that's weird. Why is it doing that? We'll be able to get it adjusted here. Okay, so the TRIN index is where? Where did that now pop to? There we go. Okay, so the TRIN index, right now it's trading at 0.75. When the TRIN index, the close of it, not where it trades intraday, when you just simply take a look at where it closes, when it closes 2 or greater, that also signals the majority of the time, not 100% of the time. You can take a look at the green decorated arrows on my screen out here, and those would be the times that it actually worked. And the red arrow is the times that it didn't. Now, this chart just takes us back into the beginning of 2015. So if you're just trying to understand in 2015, how well did it work? Let's see, you've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. And then you've got 13 from but that was on Thanksgiving, so I really kind of ignored that one. So it worked 11 out of 12 times to give you, again, that either bounce or bottom signal out there. It's where, and the time that it failed was back on the August 21st timeframe, when the market and the China stuff just simply, went to heck on a. You thought I was going to say something else, in a handbasket out there. And the question is, Steve, is that on a close also? This is on a close. So it's not really with regard to where the TRIN traded to during the day. There's other uses for that, but that's not what I'm referring to here. And, if you go back, let's see if we can take a look at it. Looks like this was, September 28th. You had the TRIN index. Looks like it closed. I don't have my data tools open, data window. So the TRIN index, and we'll go take a look at, probably we had a combination of, so on September 28th, we had a TRIN reading. The close was 2.52 out there. And I imagine if we go back and take a look at the VIX index, we'll just have to eyeball it. That was September 28th. Let's go back and take a look at September 28th for the volatility index out here. So September 28th. September 28th, yeah, we saw the VIX index at that stage went from the prior day's close was 23.62. So if you add $2.30 to it, would be 26 something. The actual close was 26.83. 27.83. So we had just simply a nice, greater than 10% close there. So if you put those two things together, that might assist you with regard to trading the volatility index as well out there. Okay, so let's go back to the markets out here. Let's take a look at the Dow off 170 now. So it looks like that 10-minute pattern has certainly failed. Let me switch over to some other charts out here. Tools. Give me a moment here to do that so we can see what's going on. So you got the Dow off 171, S&P down 23 points right now. Let's take a look at a couple of different time frames out here. Let's take a look at the 10-minute time frame, see what's going on, see if price is continuing to move lower with less relative weakness out there. And we'll have to do that when we get back. It looks like the answer to that is no, but we'll go take a look at a 30-minute time frame, see if there's any information that we can get there. This is Steve Rhodes with TFNN. We'll be right back.
Are China A-shares hot or not? If you trade China A-shares, now may be time to take a closer look. Trade CHAU or CHAD, Directions Daily CSI 300 China A-Share Bull and Bear ETFs. China A-Shares in either direction. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC. TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
It's true. Life is all about choices. At Everbank, they're making it easy for you to make a smart one with this special cash offer. Open a new yield pledge money market account with funds from another financial institution, or deposit new funds into an existing yield pledge money market account, and you could earn up to a $500 cash reward. And if you're opening a new account, you'll also get their new higher 6-month bonus interest rate, along with their yield pledge promise that ensures your yield will always be in the top 5% of competitive accounts at banks nationwide. Open a new account or add to one. It's your choice. To qualify, you must meet balance and other limited time offer requirements. Go to everbank.com/TFNN for details and deposit options, or speak with one of their banking specialists at 1-855-750-4051 for more information. You must act by December 31st, 2015 to be eligible. Everbank is a member FDIC.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
Welcome back, folks. We've got the Dow off 193 right now. S&P is off 25, and I would put some of these other charts up on my screen, but that portion has frozen, and so I cannot do that. We can't go take a look at those intraday charts out here. So we're going to go take a look at something else in order to give us a feel. Well, now, one of the things we haven't looked at is Goldilocks. So you've got, or the U.S. dollar index. So when we took a look at it, in one sense, by looking at what was going on inside the euro. But take a look at this move here. Now, again, I've got a 10-minute delay inside the U.S. dollar index out here. But take a look at that one-day move, and obviously massive volume behind the move out here. And it is interesting that, and the correlation between gold and the U.S. dollar out here, it's more of a directional correlation. than it is anything else. As we can take a look at gold, it's trading at 1062 out here. Here's the daily contract. This is the 2016 contract that we are taking a look at. No bullish reversal signal out here. What can we really say about gold? It was moving lower. It was doing it with less relative weakness out here back on November 27th. It looks to me like, let's take a look at the GLD, just see what we've got. 4.5 million shares here today. Yesterday it was down with Crestor, I believe it was. No, it's down with 10 million shares yesterday. It's done 4.5 today. Looks like it's going to be a little bit light on the move higher, but gold is trying to form a bottom if it has not already done so. With regard to where are the markets going to likely head to, let's go take a look at the S&P futures contract. Let's take a look at that. It's off 28 points, trading out at 2,053. Let's go ahead and put our, this is not what I want to do. It's easier if I go switch over to this tab. Give me a moment to equity futures. There we go. So here's the daily. We'll go ahead and blow this up on our screen. So as we take a look at the ES mini out here, we can see that it's trading at 2,052. It's very likely its next move is going to be down to 2,045, 50, 2,045 and a quarter, 75, somewhere right around there. Two or three ticks out there, and you're trading at 2,052. Why do I say it's likely to head down there? Well, we've got a couple of things going on. One, we've got our TAS market profile, our weekly top of the box. Old resistance ought to be new support. That's 2,045. What we also have out here is we've got a swing point for it to deal with. Now, it is testing that swing point right now. That swing point being the trading session of November 16th. So the top of that was 2,051. The actual low that we've seen so far is 2,051.50. So in essence, it looks like, it should be able to get through that. If we see a close below today, 2,045.60, now here's where it gets a little tricky, right? Then you're likely to see that VIX index one-day rate of change greater than 10%. What you also, this would be communicating is it wants to perhaps go back and test the bottom of that swing point from November 16th out here. If instead this level holds, then you would anticipate a bounce, especially if we've got that VIX one-day rate of change greater than 10%. Now, if we take a look at the NQ itself, right, it's right now testing its bottom of its daily box out here. The price on that low is 46.06. You're trading right now at 46.07. The actual low so far has been 46.0575. If it fails to hold price here, then it says that it'll head down to 45.92 to 45.23. Those would be the levels that that you would be taking a look at. I wish we could go take a look at some intraday charts out here to see if price is moving lower with strength or without strength, but we can't. Otherwise, I would be happy to do it for you. So, folks, stay tuned on this terrific Thursday, because coming up next is David White. After David, Tom O'Brien from 3 to 5, and, of course, Andy Heck to bring it on home for us. So have a great Thursday, and I look forward to seeing you on Jobs Friday. And you know a couple of new things to be paying attention to. Take care, folks.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
You're watching Tiger TV.